Hey everybody, welcome back. Well, we have a lot to go over in a short time to do it, so let's get into it. First and foremost, we're going to go through a lot of economic data and look at what the numbers actually told us on Friday. I think that's what a lot of people are missing. I don't think they really got how bad that economic data was. We have to go over tariffs, sadly, and what's going on out there. And we're just going to start with the basics, and then we're going to drill into the technicals and then overlay it with fundamentals and more of a macro picture. Let's do it. Quick reminder to subscribe to this channel and click all notifications. These videos come out at different times. 27.5% of you that watch this video do not subscribe to the channel. It's probably a pretty good idea since we follow them along during the week, meaning Saturday's video is our anchor and then it carries us through the week with the other videos that come out every day. All right, let's go. Obviously the basics. You really don't need me for this. I mean, here's your trend line. Here's where you've rejected. Here's where you're at. What we refer to this kind of area here is you have a lot of pieces of what I refer to as confluence. So you start here and you have your peak VWAP there. And then you go to August 5th and you have your other VWAP there. And then you have this support line. So you have what we would refer to as three pieces of confluence, or how I refer to it. And then we would drop in our 200-day moving average there. And then, of course, we all saw the 22 there, which is screaming down. So when we look at everything here, and that's just the big ones, but you have 5 pieces of confluence in this little spot. It's a lot. Now, the idea that we were going to magically lift through that, like someone was going to just lift us through that and everything was going to be okay, we were going to go back up, is pretty much delusion. And we've been talking about this. You have to rally, come back, backfill, try again. It takes time. So when you look at the market, you'd have to say, okay, well, what kind of market am I in? Am I in an uptrend? Am I in a downtrend? And get a sense of that. Like, does this look like a downtrend to anyone? I mean, if everybody could just take a break for a second and say, oh gosh, you mean stocks aren't going up? They haven't gone up in 3-4 weeks. Like, give it a break. Let it figure out what it's going to do before you tell it what it's going to do. Do you have issues? Yeah, we have issues. I've got lots of issues. But like, if you look at something like this, yeah, you broke. Okay. And well, now you watch the next levels and you go from there. If the charts aren't set up and you're not seeing opportunity, you just don't do anything. You don't have to be involved every day. There's some delusion that you do. Are there trades every day? Sure. There's day trades every single day. There's always something moving one way or another. But when you see that and you say to yourself, oh, I'm a long-term investor, then you're a long-term investor. Then you really don't do anything here. But what I do from time to time is I will just go back and I'll old school it. I'll just go look at open, high, low, close. I used to have a client years and years ago. He used to actually do the X's and the O's, which is kind of crazy, but he loved it. But you look at something like this and go, okay, well, what's this telling us? Well, I like looking at open, high, low, close because it tells you a little bit more of a story sometime. We popped over, you undercut, you closed at the low, you completely encompass this bar. So when we look at this kind of stuff, it's not ideal. I mean, we could say that, oh, we closed, not here, but you have to look at it for what it is and then say to yourself, okay, well, where could we get to? Well, before we get into all the fancy doohickeys and technicals, it's pretty realistic if you just looked at open, high, low, close to say, yeah, you could easily get to 53.80. Like, that's very doable and in a very short period of time. When you rally up like this is what happens. You're looking for people. And you found people. You're looking for demand. Why? Because you have supply to sell them. And then when you sell them, they figure out, oh no, I bought the lemon. Then they get out. And so that's why these things are always so vicious. It's always like, why here when they reverse, they're so vicious. Now, you have some data coming out, and this would be a good time for us to talk about that. But we have this April 2nd deadline looming. And I think it'd be good to just take a second here. Now, we're all aware of the tariffs, but I don't think people are truly understanding what's happening here. So what I mean by that is this. Several weeks ago, maybe even a month ago at this point, we showed this graph. And the graph that we showed very clearly talked about one thing in particular. And that thing was economic uncertainty and how it was rising and how it's actually at all-time highs. And not only in the US and globally, and we're going to talk about global names here in a second. Has the economic uncertainty dropped at all in anyone's mind? And anyone would say, no, I'm more confused than ever. It's like the other day, and I'm not trying to make light of it, but oh, we're going to have a 25% tariff from here, but I had a really good talk, so maybe it'll be 18%, or maybe it'll be this, or on Tuesdays, if the car's blue, it'll be okay. You can buy blue cars on Tuesday, but Wednesday, it's got to be red cars. Like, this is not a way to run anything. And I'm not going to get into the politics of this, but this level of uncertainty, what happens? Everybody freezes. And you can see it in the data. It's very clear. Now, if we listen to what the Secretary of Treasury said, what he came out and said, he basically said, okay, well, this is not our administration or not our policies and our economy for 6 to 12 months. So he's telling you, like, yeah, things are probably going to be weak until we straighten out what we think we have to straighten out. And I understand that, yeah, we can't keep growing through government spending because it's actually tax dollars. Like, that makes sense. Changing policy every 2 to 3 hours, depending on if somebody was nice to you, is not a way to go. And I think that when we're saying this, and again, I don't really care about people's political beliefs. What we have to understand is this level of, am I going to put billions in that country or billions in that country or billions in that country? It's not going to work. It's going to be very difficult. And this delusion that, oh, I'll be fine in Germany or fine in France came to an end, or I'll be fine in Japan came to an end. And I'll show you those charts in a minute and why you should be looking at very specific other countries. But Donald Trump's scheduled this April 2nd date that's looming. Now, will we get more certainty that day? Or are we going to get less certainty that day? We don't know yet. It's going to be our Independence Day. I've felt independence before. It doesn't feel like this. Yet few investors expect definitive guidelines they seek. That's the problem. When I show you this data and how it switched so fast, that's the problem. We're getting there. Investors bullish growth, but instead stock market swooned. So we were promised massive M&A activity. M&A activity is down 23% year over year from the Biden administration from last year. Headlines on tariffs whipsawed Wall Street, knocking the S&P down as much as 10% earlier this month. Thanks, Rocky. And so here come the people, and this is what they're going to do now. Barclays going to slash it to 5,900 from 66. Goldman did it. JP Morgan did it. Everybody's going to do it. Why? Uncertainty just breeds get me out and let me figure it out later. It also presents massive, massive opportunity. And we're going to get to that today. But U.S. global wealth cut from 64 to 66. And I get it. But when you start trimming, and this is what I want you to focus on. See this right here? We're going to segue because this is important for people to get. People think that this is stagnant. No, it's dynamic. Now, if you're in the community, I'm going to go over this again, but you heard this 2 weeks ago, but I think it's really important to just get this out there. This is Yartini, and anybody can get his stuff. If you're not getting the free newsletter, get it. There's a link in the description to get the free newsletter. Also, if you're trying to get into the room or you're trying to be a member of the community, get on the wait list. It's getting to the point where it's getting to a high percentage of being filled, and then it's just going to be one for one, in for out. There is a finite number of people that will be in there. And the reason for that is because I'm trading and I can't have everybody obviously in there. So it's a finite number. It's not like other places or other communities, just FYI. So if you're interested, get on the wait list. All right. So what are you showing me now? All right. So you can always just Google this, Yardini. And when people always say, well, who do I follow on Twitter? Who knows what they're doing? I've been following this guy for over 20 years. And the reason that I want to go through this and explain it is because you need, even if you're day trading, you need a macro overlay of the environment that you're in. Even if you're day trading, you just do. You need to see where the players are because then you can see where money's flowing. And this is very important. So you can see the legend over here. You can spend all day with this thing if you want, but I'm just going to get to it. Essentially, this is PE that you're looking at. You're not looking at the S&P. You're looking at PE. It does look like you're looking at the S&P, but you're not. And you can see that by forward price earnings ratio and his forecast range. Well, his forecast range dropped from 22 to 20 and then went from 20 to 18. So we were in this range and now he's downgrading the range that we should trade in. Why is he doing that? I'm glad you asked. So there's a couple. I'm going to have to clean that off. We're not going to have time to edit this. When we drop like this and we cut earnings, and we have massive uncertainty, you pay less for the earnings. So if you were going to buy a company, and that company, I'll give you an example, we'll use CoreWeave for a second. If you had a company and they had $1 million in revenue and you were going to buy that company, if they had 20 clients, you would be like, oh, I've got a diversified database out here. I'll pay $1 million for that company. If you were going to buy a company and they had 2 clients that were 80% of your revenue, are you going to pay the same amount for that company? No. It's no different than the market. So when you have more uncertainty, the valuation of what you're willing to pay for a company, which is what you're buying when you're buying stocks, a lot of people forget that, actually declines in value. So what happens to you during corrections is not only do the earnings maybe come in, but the PE contracts, and that's what this is showing you. All right, back to us. It's a really important segue. You might want to get that again because a lot of people just go, oh, well, that's not that bad. No, you're missing the other part. And this is the thing that we're talking about. So we actually shorted Lulu. I'm going to walk you through that trade later in this video, but I'm not going to do it right now because there's too much to go over. But I got asked to start showing trades again, so we're going to do it. But anyway, how much profit can you squeeze out of each dollar? Value may account for about half its expected drop in key measures of performance. Oxford Industries, Tommy Bahama, Lilly. Stronger results for the latest quarter expected, but still saw the stock fall down 3.1%. Why? Tom Chubb said deterioration in consumer sentiment also weighed on demand. I wonder why we have issues with consumer sentiment. And that boils down to Friday's, we'll call it data, for lack of a better term, but it was just a disaster. And it doesn't really look like one on the front of it, does it? What it really looks like is that, oh, everything's just fine. We only upticked a little bit. When you get into this, it's pretty ugly. So core PCE price index, 0.4 versus 0.3. Personal income is up month over month, which was good. Personal spending was down. So what they're telling you right in this area is that, yeah, you might be making more money, but your spending is less. So that's another issue. And then at the same time, the PCE price index month over month stayed where it was year over year, but core ticked up. And that core ticking up is something that we have to watch. This in and of itself, from the 830 price point, that really wasn't our problem. This whole thing really wasn't the problem. The problem really comes in later in the day. And when we say it, you can't unsay it. It's like one of those things. Look at these numbers in here. You see Michigan consumer sentiment final, expectations, current conditions, inflation expectations. And then you see what the consensus was on there. And you look at this and go, okay, so the final wasn't that bad, but we went from 3.9, now we're over a 4 on inflation. Expectations 5.26, we were looking at 54. Look at the previous number. So they were expecting a bloodbath here, and they got it. So in front of us, and just to highlight this, is Michigan consumer sentiment expectations, Michigan consumer expectations. And what this is showing is I just grabbed a 1 year, because that's all that we really want to focus on. Everything was good, just like a turkey for Thanksgiving, like life's great until Thanksgiving, right? And then there's a bill to pay for it. And you can kind of see what the bill is right there. Excuse my weird, but there are certain levels here, and if you're truly interested in this stuff, I would suggest you get the book, The Hedge Fund Edge, that explains this stuff in great detail. But what this line's telling you is anytime you're below 55 on consumer expectations, you're pretty much in a recession, or you're significantly close to cutting rates. But you can't do that because of where inflation is. And that's when all the nerds come out and start saying things like stagflation because they want to seem cool. So again, consumer sentiment, where does the consumer see themselves? Well, this little area here, there we go again with these, I don't know, I should just really use this. It's just so much easier, right? There we go. Much better. So when we see this, 64, 65, it's like, wow, that's really bad. Look at how we're dropping ever since, we started tariff talk. And then people are like, that's it, I've had enough. And that's exactly what you're seeing here. You're seeing the, I've had enough, we just have to wait for this to settle down, and we're starting to see that puke level. So we get what you had on Friday, which is a bunch of raccoons floating in a dumpster on fire down the river, which takes us back to the S&P. Now, how do we tie it all together? The same way we always tie it together with the stool. We're looking at the macro, the fundamental, and the technicals. It's really clear, and we did this on that live on Thursday, but here you are. You want a macro issue? You got one. Tariffs. It is scaring the bejesus out of people because of the level of uncertainty. Who's affected by it? Consumer discretionary more than anybody, and we've seen this. Actually, Ferrari did well because they came out and said what their plan is. And then you come here and then you start looking at the technicals, and that brings us to these charts. If you are just looking at the technicals during this, when this bounces, or I want to be real clear about this. When this bounces, and it always bounces unless it's going to zero, when this bounces or when the other areas start to roll, you're not going to understand why they're rolling. And that's really the deadly part of this. So in other words, when you look at the SPX and we say, this looks bad, which is how we started that whole conversation, now look at it. Okay, great. What about other things out there? Well, why aren't we looking at the DAX? And this is where it gets super interesting. So to me, to go and say we're going to buy Germany right now with the tariffs is absolutely crazy. And people are starting to realize this. And you're starting to see the roll. Now, what I mean by the roll is when we start looking at the DAX, you're starting to see the 12 and the 22 start pointing down, and they're getting there. Now, if we hold in here on the 55, great. If we don't, but I don't see how this holds. And I think you're starting to see this spread everywhere. You started to see it in my opinion, you're going to see it here specifically in France. And this is one of the reasons why I was saying to people, yeah, you want exposure overseas, but you need to be super careful. All this stuff's getting super toppy, like super toppy. And you can see this is a massive RSI divergence, massive. And again, I don't really care if you use this stuff. if you're a long-term investor or not. It doesn't really matter to me. Gravity doesn't care if you think it exists either, but this is there, and I would be paying attention to this. This is definitely there. It's definitely an issue. My personal opinion of how this is all setting up later in the year, please listen to those words. Not Tuesday, not Wednesday. So when it doesn't happen, don't say, well, you said boo. That's what you sound like. So what you want to focus on is you want to focus on what's your time frame to trade. For me, if I'm buying weekly or monthly, that's how you have to look at it. All right. So that's why what we did was look for certain countries that aren't affected by anything. Like, we don't have to worry about the auto industry really in Poland, but they benefit greatly from what's about to happen. And what we're seeing here is that that's what they're looking for. So they're going after areas like Poland, and they're putting money into areas like Poland, and we can see this in how it's holding. If we go and take a look at something like Argentina, Argentina's holding in here. You have this huge flag. You peaked with surplus because people are like, well, this is as good as it's ever going to get. When he balanced the budget and went to surplus in 18 months, crazy how that can work, isn't it? And then what you're seeing here is you're seeing kind of this flagging formation out there. And do you want to buy this? I don't know that you have to buy it, but I'll tell you right now, money's going to flow into certain areas that have nothing to do with tariffs. That's where money's going to go. It's not going to go into these other areas where you have huge weights of, such as this, watch. Like, everybody was so excited to buy Japan. Everyone was so excited to buy Toyota. And now you realize that by the time that you buy a Toyota, it's 25% more. And then on top of that, this is what you have to realize. April 2nd, then we're going to just hit this with, oh, are they going to retaliate? Because then we're going to double retaliate. You know, until it turns out that you're paying $250,000 for a Camry. And it gets to that kind of like level of absolute ridiculousness and where things just come to a grinding halt. And this is the concern that everyone has. And that's why that stuff dropped off a cliff. So when we go back, again, we're going to tie it all together. When we go back and look at the S&P and we're looking at this and saying, well, what's going to happen? Well, right now you have to assume that that's going to come in. And when we look at the simplest of things, something like looking at the RSI here, and you can see the higher high. And, you know, a lot of people, I talked about this. If you go back to February's video, the 21st, we talked about this. Like, this is getting weak. You know, we got out of all our tech names, and here we had a bunch of swings when we got out. Just not because we knew this was coming, but just you could see that it was starting to get weak. No one ever knows it's going to be like this. They'll say they do, but they don't know. Because it could just turn, right? I mean, that's the point of all this. It could just turn. April 2nd, he could say, you know, April Fools, no tariffs. We don't know, and we don't know how it plays out. So to pretend that you do is just delusion, not only to other people, but to yourself, which is 10 times worse. So what we want to do is we want to just focus on what's happening. Okay, so we have this here, and we can see that it's obviously negative divergence. All right, so where does that leave us? Well, that leaves us trying to understand what institutions and retail are doing. And I think that that's really what we have to focus on. So what are institutions doing? Remember, when we look at smart money, dumb money, and I got asked to cover this again and give an update. That's why I'm doing it. If you need something or you have a question about something, drop it in the comments. I try to answer every single comment, but more importantly, I read every single comment because it helps me create content, which is the whole purpose of doing this. But I just want to be really clear about this again. We don't refer to this as smart money, dumb money, because that's deciding what they are. This is institutions, this is retail. Once you understand what they are, then you can make your own decisions about how to trade it. It's like with every indicator, guys, you want to know what the heck you're looking at, not what someone's telling you. Whether it's, you know, anchored VWAP or a 5-day moving average or, you know, the 30-week moving average. Like, why are you using this data? Like, you always want to understand the why. Because once you do that, then you can utilize it the best way for you. Everybody trades differently. When I look at something like this is really fascinating to me. And I'll explain why. And we'll get into a shorter time frame. But I need to break this line. When I break that line, that's really when these bottoms are in. So if you look here and you go, oh, well, that's when we broke the line, and you draw straight up from it. Any of these, when you broke, and then it looks like you're going to break, but once you break that line and you start going down, that's when your bottom's in. And, oh, we look like we're going to bottom, and then we don't, and then we go to here. And I don't really care what anybody thinks about this. I truly don't. But I mean, you know, again, that one's drawn awfully. It's actually over here. I don't really care what anyone thinks about this. You know, it's like some of this stuff to me is almost like gravity. Like, I don't really care if you believe in it, but when you start to see it and you understand what it is what it is. And it doesn't mean, again, you have to think about your time frame. If I'm looking at a 3-year chart, and you're saying, well, Wednesday I'm going to buy zero-dated options on Tesla because smart money, dumb money's here, then like I just can't help you. Just stop trading. But if you look at something like this and go, okay, well, what happens when institutions are out there buying as much as they possibly can as this plummets, and retail has given up and starting to roll back over? Well, that's telling us a couple things. And one of the key things that it's telling us is they're not done selling, meaning retail just got back in the market right here and they're ready to dump again. Now, if we look at the last hour of trading, and I haven't shown this in some time, but I just want to do this. The last hour literally is exactly what it is. No idea why I'm crossing it out, but the last hour is exactly what I said it is. It is the last hour of trading. And I just want to show this. So if I come across here and I just put this in for a second and say, all right, well, what is this telling me? The last hour of trading is calculated by, you got it, the last hour of trading. This is going to bother me, so we're going to get rid of it. And why do you care about this? And so again, your comments are, when you're showing me something, tell me why I should care about it to some extent. So, all right, let's get into it. +1, -1. If I'm buying more at the end of the day, then I'll get +1. If I'm selling more at the end of the day, I get -1. Takes the last hour. It's Sentiment Trader that calculates this out. I'll tell you what I like about it. It's a long-term indicator. So when you get to what I refer to as peaks or trough valuations, meaning you did here, it's long-term. It is not short-term. And I want to be really clear about that. So you can see from this and all that selling, how long it takes months for it to catch up with you. It doesn't take weeks. So when you're looking at these indicators, you have to understand what time frame is this indicator telling me. Well, this one's telling you that, yeah, you better start thinking longer term, not shorter term, where you could look at smart money, dumb money and say, well, that's telling me over the week that retail's probably going to puke and institutions are going to keep buying, which ties directly into the last hour, which goes, oh yeah, at the end of the day, they're buying. Now, we didn't see much of that Friday. We'll get into that in a bit here, but we didn't see much of that on Friday. But if I look at these levels, and even if I drew this just a little bit better in here, and we just kind of got that area just a little tighter, we'll see that this was kind of a trough valuation area for the last hour, where they kind of start stepping up to buy. Now, what that means for us is this could go on for weeks or months where they're at that level. And these peaks, they take time. So when we're seeing this, and what I'm saying to you about it is, it doesn't mean that you're going to go up right away, but understand underlying that the last hour and where they're at, this might fall into that rebalancing that we're all talking about, where for some reason equities are supposed to be bought on March 30th. We'll see, and we'll go from there. So when we look at the internals that led to the bounce, and we look at the S&P and just look at this on a daily, you can see this pretty clearly. We can always go back and look at this on a weekly basis, and maybe that would give better perspective to people so they can see it there. And again, what we're going to do is just mark these off so that you can see for yourself and say, all right, well, here's a 50. So on this right here, this is the S&P and this is the 200-day moving average on a percentage basis. And then this is the 50, the 20, and the 5. And the longer you go out, the better. But we're just going to take a snapshot of it and say to ourselves, okay, well, when we're below 50, do we want to be long stocks or short? Until this gets back over 50, you do not want to be going out there and going crazy. You don't know if we're going to get something like this, which happened from January 22nd and didn't really peak over it again to November. We don't know if we're going to get something like this for 6 or 7 months. We think we might, but we really don't know how this is going to go. So what we want to focus on more than anything is this is the hand that we're dealt right now, and we accept it and go, all right, well, when we broke here again in September, and then we kind of got washed out, we started to lift, and then that lift over led to this great run. So what we want to do from a longer term perspective is wait till we get over that level. And I think that's how you need to view it. But you can't get too excited about the market overall when you're breaking here. And I think that's really important to get. If we look at something here like the 50s, you can actually see you really want to be above 50. This means 65% or 67% of all stocks now are below their 50-day moving average, which means that they've lost institutional support. You can see over time that it was actually worse at one point. And let's go back to the daily on this so that you can see that area. But what's happening now? Right, you're getting to those levels where, oh, okay, here was December, and then we start to rally, and then we're back up, and you can see how this is going. You could come down a lot more. So in other words, we know where the 200 is, but if the 50 was going to get to some kind of trough level, this is really those kinds of trough levels, and we go back here to April 24. If you get into a level where you're at October 23, if you really thought about this and said, all right, I see where we're at, and maybe we're going to bounce, but is this really at an institutional trough level where they have puked everything out that they're going to puke? No, it's not. You'd have to look at this and say, well, October 23, this got down to a 9 or a 10. And then in 25, we had this drop. We're still up here. So Well, again, when we look at this, you go back through time and just go, all right, well, there's times when this thing, my gosh, this got down to, 5 or 6, or 20. Where are you? 33. Based upon your time frame, you would have to look at this and go, man, we have more to go. The other thing that would get me concerned here on the 50 is that you're not even below where you were yet. Now, does that mean you have to get there? No. But it does mean that if this gets worse, it's going to speed up. That's what it means. It doesn't mean it's got to get there, but if it gets worse, the speed in which this gets worse will accelerate. We saw that on Friday. So then we look at something with the S&P on the 20 and you're just in the middle. It's not really telling us much. It really isn't. It's kind of no man's land. So it's kind of fitting with the 20 or the 50 and the 200. Go to the 5, or are you at a trough level there on the 5? No, you're at 25%. To have a trough level where you're going to have some kind of bounce, these things get to 4, 5, and you're nowhere near there. So on a breadth indicator, you're not grossly oversold on the short term at all. You're just not. And on the long term, it looks, for me, from the 50 to 200, when I go and take a look at that yeah, this can get a little worse before it gets better. McClellan Summation Index, when we go and take a look at that, we can see that we flipped right in here again. And now it looks like we're trying to flip back or go sideways. I don't know that we're going to crack all this. And I want to be really clear about that. Nobody does. Here's support level. We've been holding in here and going from there. You don't know if we see some kind of global tariff strategy that just comes out of somewhere. We don't know if that's where this is all going. And I really want to point that out there over and over in this video, because the idea that somebody actually knows how this is going to play is ludicrous. So we have to go out there and say, yep, we have to watch the market and go from there and just look at the technicals. But to get into this, I think we should look at some of these sectors. Now, the two that I would focus on, for me, that I think are the most important that you have to watch are the XLF. And the reason for that is you cannot have a correction in the S&P without losing XLF. You just can't. So when we saw the JP Morgans of the world start to rally, and just quite frankly, they did not gap fill. They held. But Goldman, let's go through this. Goldman couldn't hang on there, and they rolled. So when we see something like this, we want to pay attention to it. But here's where I'm going with this. So here's the XLF, and I'm going to spend a little time here. If you lose financials, you lose the market. I don't know that you're going to lose financials. I'm going to just show you a couple things. So APO completely, utterly collapsed. We went from we're going to have all these mergers to we're not going to have any mergers, and your carry interest, yeah, we're going to take that away from you. And that led to KKR. Up here, and this is a great example, we had a swing trade on, and then when it broke, you had to get out. And if we didn't, that's why you have to honor your stops during these times. I mean, it would have been another 50 points. But the purpose of this is when you start to look at these valuations on these names, they're not breaking down anymore. So when I go and take a look at like the SPX, and it looks like that, well, KKR doesn't look like that anymore. You could say, well, it's still got the same pattern. The veracity in which these names are moving down are starting to hit some trough valuation levels. And when we're looking at these subsectors that dropped first, because they're subsectors that dropped first, and when we look at those, the whole KCE space, you guys remember the capital market space? Like this dropped first. So we always go back and look at what dropped first. That's a subsector of the XLF. So then you go, all right, so if I lose the XLF, then I have a problem. And so what I would suggest is going and taking a look at that. So for me, if any sector that's above that 5th level when the election happened, and we can just see how we're testing these levels, it's really important for us to get that, right? All right. So as long as we're not breaking that, you're good here long term. But getting up into these areas, this is where you start running into a problem. So if I drop a VWAP right there, and I like VWAP, the time and place. What you don't want is what happened on Friday, which is the peak people who thought they were fine, the people that bought peak VWAP, they're not fine anymore. They're now underwater. So those people could exacerbate the sell of this. And then that ties us back to something like this and cleaning it all off and saying to ourselves, all right, well, where are we with the big moving averages? I use a 12, a 22, and a 55. You should use what you're comfortable with. I actually explained that live Friday, that post-market live. I'm probably going to do more of those. People seem to like them. But you're below everything. And then we could go here and say, oh, well, here we are. We're below on the 5. I'm just going to say this. So, and you can do what you want with it. I like when I have the color changes between the 8, 5, 3. When it goes red means stop, green means go. It works for me. It's a way to look at the market. When you're in a correction phase or a consolidation phase, using this as your be all end all, it's a real problem. because you're going to be buying when this 5 flips and a retest of the 5, and you're going to be getting in here versus people that are getting in here that are using something like RSI. Right? It's a huge difference. And again, I really don't care what you do, but if you start to see these where you're bottoming out and then the RSI is holding in here and then you break out of that, it's pretty clear that that's a short-term bottom to most people. And you can see this very, very clearly. It depends on, your time frame and what you want to do, but like here you are, you hit, and you can see the turn right here and then the gap up. Well, that's a much better entry than me sitting here waiting for the 5 to rally up, come back. Well, maybe it'll back test, and then, okay. Meanwhile, I'm in down here and I'm selling to you. Like different tools in the toolbox during different times. Let's get back to this. So what are we getting at here when we look at the RSI and we look at the 4-hour? Well, to me, we tried to rally and failed. And so we need this to prove itself. What I would do with these kinds of situations is I'd go through and just mark all these levels off and just start looking through 4-hour charts and going, all right, well, if financials really can't get over like 50.26, which is the breakdown bar of this, then do I really want to go out there and be buying financials unless they puke, like absolute puke valuation? So, okay, where's puke valuation? Well, I'm glad you asked. So it would get us back to this level, or to me, puke valuation on buying financials is, a 5% drop, which could happen in a couple days. I mean, it's not a big deal, but it could happen. I mean, when you think about how this one happened from March 3rd down to, the 11th, it could absolutely happen again. And all this means is that we're consolidating. So if we take a look at that, and then we go and take a look at something like the SOX, which I think we should spend some time on, these are your two big dogs. If semis don't rally or go sideways, it's impossible for the NASDAQ to go up. It just is. Same thing with financials. If you go back and look at history, you'll see what I'm saying is accurate. So when we go here, you can have biotech lead for a little bit like you did in 16, but eventually it'll just crater. You have to get semis. So if we look at this on just a 4-hour, we take it back to 24. I mean, anybody's going to look at this and say, well, that's a head and shoulders. Like anybody's going to look at that and go left, head, right. And you would be right. And you can see that. I do see it, and I think it's an issue. And I think you're starting to lose. I think you're really starting to lose a little bit of like European semis now too. And some of these things are going to be on a value basis. We're going to have to look at that. We're going to have to talk about some of these names in a moment here. But what we want to do is say, well, this is what's happening. And then we go look at something like the RSI, to me, on a 4-hour. And you can see how we held here, but you haven't even broken yet. So when we go back here and go, well, what are the levels where this thing is completely washed out? Where are those like quote wash out levels? And you'd go, okay, well, 20 seems to be it. And really what you do is you just kind of drop a VWAP there, or drop a line there, VWAP. You drop a line there, and then you'd look at it and go, well, in 18, this was kind of washed out. We were washed out here. During the pandemic, we got washed out here. And I'm not saying you're going higher, but I'm saying you're done going down and maybe you bounce. And then we can kind of go from there. And you can see this, right? Some of them bounce, retest, and then bounce again. And what I'm getting at is, you're not even at that level where you might bounce. You're not even seeing that. You see these levels right in here and then right here over and over again. You're not even getting to that. And I think that that's really where the important part is. You have to think of it from that standpoint. So when I look at something like this, I'm like, oh, I was washed out here and I haven't even broken that yet. That means to me that you can go lower. If you look at this on like a weekly, you'll see how it's setting up. And where does that get us? Well, you have that one level here, but your long-term level on the SOX is really right there where you're sitting. So if I'm to drop this down and just look at that, you're on major support. Like that's it. Like it doesn't get more major supporty, if that's a word, than where you're at right now. And that's the whole point of these videos. These videos are information education. It's not for me to tell you that, oh, we're definitely going up. Oh, we're definitely going down. It's for me to take a snapshot in time and say, this is what's happening. This is where you have to watch, and you want to see how you act at this level. That's what traders do. They don't pontificate. They don't say, oh, we're definitely going up or we're definitely going down. There's no faster way to find out if somebody really trades or not than when they say silly things like that. You have to take the data and then you analyze it. So like when I'm looking at this and saying, okay, we're getting to a month's end, I'm like, okay, well, that's a black Marbuzu bar, meaning I opened at the high, I'm closing at the low on a monthly chart. Like that sucks, for lack of a better term. And I don't really want that to happen right here. So I need this to hold. And then I look at this close and say, well, this is the single worst close that I'm going to have on the SOX on a monthly chart since 2000 and what? 23. So that's not great. And we have to just call it what it is, because that allows us to make better objective decisions. So I hope that makes a lot of sense. We're going to get into some names now, but your goal as a trader is to just take all this stuff and then just analyze it, make the best decision that you possibly can. Now, one of the things that I just want to point out, there is no group that's still more at risk than consumer discretionary. None. And I want to show you what I mean by this. So we can see where consumer discretionary is right now on a chart. We can get into the technicals, but this is, and I think it was Edward that asked this on the call. When we did that public call, he's like, give me an example of, show more of like the stool, like show me how the fundamentals and the macro and all of it ties together, and then show me the trade. And I did a small one there, but this one is really easy to do. So America's richest 10% now account for half of all American consumer spending. I want you to wrap your noodle around that, because that's a third of our GDP. Like if you really think about it, and we could argue if that even is GDP or not, but 10% account for half of all consumer spending. So if you make a quarter, then you're basically looking at something and saying, oh, I get to buy the fancy handbags, I get to do this. Where are you getting your money, buddy? Buoyed by stock gains, big stock gains in real estate, other assets. Sorry, I made myself laugh. All right, well, at least I think I'm funny. All right, so when we understand what's leading this, you can go, well, what about XRT? I don't think XRT really captures the XLY, because yeah, you have Amazon, but you also want to look at your cruise lines. You know, they're not going on the fancy cruises. You're not going to Alaska. You're not seeing a bear from a yacht or whatever. Like, you're just not doing it, right? You're like, all right, let's just chill and stop spending. Why do you care about this? Because if you're looking for areas that could get absolutely decimated, this is nothing compared to where XLY on a valuation basis could be. I'll show you. This was actually posted in the community, and it's one of the things I love about it. It's like, because everybody shares ideas and things like that. It's an actual real community. So this is from Goldman, and it was posted in this morning, and I was looking at it. I'm like, yeah, that's pretty accurate. Here's the S&P, and this tells you where you are on an absolute basis, on a percentage basis. So if you think about it, of 1% being like a trough valuation and 99% being a high valuation, right, in regards on a relative basis. And then you kind of go here and go, well, where are we? Well, what this is going to highlight is the following. This is going to highlight that consumer discretionary has the highest PE of anything out there. What has the lowest? Energy. So if you're like, I need to commit money to the market, I want exposure, it's going to go into energy, because energy is almost half the current PE of consumer discretionary. And you're like, but yeah, this is where the growth is. Is it? Because if you just watched any of the consumer sentiment data that I just showed you, it's telling you that they're done. So it doesn't, like when you look at that consumer sentiment data, it doesn't tie to any place stronger than consumer discretionary. It just doesn't. So when you see this kind of stuff, you want to pay attention to it. But you're in a 30-year 85%, 10-year you're at 57. This is really important to think about, because historically, you're still up there. You're really up there. So we want to pay attention to that. And I think that's very important. And that ties us into things like Lulu that we just talked about, where, oh, okay, well, what's Lulu going to do? Well, they're telling you we're hosed. We think we're going to lose half of our profit based upon what's going on with tariffs. Now, some of these companies handled it better. But what you want to do is you want to watch these things, and you want to figure out how you're going to get up and in them and take advantage of it. For me, when I was trading this, I was concerned about putting this on. I shorted it the night before, but I wanted to build a position. And then I got nervous because of the 10 a.m. data. So by the time the 10 a.m. data came out, I'm like, I'm going to miss it. I felt like I was going to miss it. So I'll show you actually how I did this. Finally got something. That's the bar. You can't get over the open. It trades on. I'm short, and I'm just going to use high day. I'm not going to be able to wait for the number. I'm just going to put this on, and I'm just going to use the high day as a stop. And I sized accordingly. I'm not in a hurry to cover the Lulu. I'm just going to leave it on. I'm going to make money that fast. It's kind of silly not to pull something out before you deal with the bounce. There's your puke level. So that's where everyone's that bought it is going to have their stops. So you think if you bought it, you're like, no, it's a good company. It'll come back. So then you're like, I'll just use lower days to stop. Trimming into that is like nice, because they really stop hunting. If you did that short and you're uncomfortable, this is where you trim again, like right into those levels. All right, so you made your decision. I'm staying short. Some people might even want to add to that short right there, but that's up to them. Wow. Lulu, I'm up 9. The only thing I'm doing as stuff's dropping is I'm pulling money out. I'm not shorting anything more. What you want to do is just constantly be pulling money out of this market. All right, so I cut my shorts across the board, and the rest are break even. So what you're listening to there is trade management. And what do I mean by that? Meaning how you're actually supposed to manage a trade. In here, what I'm doing is I want to short, but I know that 10 a.m. data that we went over earlier in this video, I know when that comes out, it's going to be It's going to be strong or it's going to be weak. We thought it was going to be weak. It was. So if I'm waiting, then I'm going to have a problem. We talk about this in here where you can see the bounce, and then once you broke that level, that was it. And that's why I was saying in here, you could actually probably even, if you wanted to, you could actually even add to the short. And kind of go from there, because that's your failure. And then obviously that would have been your stop. And then you can just kind of see how that played out. But what you're doing with these names, to me, especially in this kind of environment, is you're just pulling money out and then you just allow them to work. So if you're short in here, there's not really much to do except use the high of the day on the rest of it. And this is the same thing we did with the AMD trade. It was interesting because everybody was screaming at me AMD was going to run the world. This is the day that we shorted it. I think we shorted it like 110-ish or something. And then, all I was doing was just using that high. But this is almost a textbook, like evening star pattern. And this is what we're seeing right now. So what do we want to do going forward? I'll give you a couple names that I think that you really have to watch what's going on in the market. So if we look at something like a NVIDIA, and what we would do is we'd want to watch some of the big dogs, and that's where your head should go. So if you look at something like a NVIDIA here, and we did the simplest of things where you're going, okay, well, here's this low trend line right here, right? Like that's your really trough trend line. You can see all the other ones that you've already really broken. You come in here, you do this a couple times, you're like bonk, bonk, bonk over and over again. You can see the other smaller ones that you've broken. All right, so we know all that stuff. And then we could see in here the same level of confluence that we've had other names. And we could do the simplest of things where we just take the peak and we just drop a VWAP and go, well, we couldn't even get there. We got all that. If we do, again, the simplest of things and just drop the moving averages down and then put the 200 in, and everyone's going to go, ooh, death cross, ooh. And so, okay. So what I would argue is that if you had a death cross and then you were looking at a year, you pretty much want to buy them. I mean, I know people are going to say that, no, you don't. Just go and take a look at them. By the time this happens, it's already over. Not from like a monthly perspective or like a weekly perspective, but if you're like saying, I want to own NVIDIA for a year, but I'm going to sell it because there's a death cross, go mark off the past death cross and then said, if I owned it 12 months higher, would I have made money or lost money? It's pretty obvious that if you're looking out 12 months or longer, this is where you buy. Again, it boils down to your time frame. So when I look at something like this, you have to go, what's my hurry here? You don't have one. The only redeeming thing that you had on Friday was that you, for whatever reason, you just couldn't fall apart and you couldn't go any lower. Now that could just be options or the core weave trade, which we're going to get to in a second here. But when we see stuff like this, we have to pay attention to it. So I look at this and say, yeah, that's a real problem. And that's really one of the areas that I would be watching. But for this to come back down and retest some of these other levels, and we'll go through this more detail in the public pre-market video, I don't really think that it's unrealistic for this thing to come back down and retest this. I mean, you would actually have to argue that you broke and you can't get over that. Now, we could all put in our fancy levels. I could put in my 5-day moving average. We could drop VWAPs all over the place. Like, okay, or I could use what's working. Well, what's actually working in this environment? See, when you're in a consolidation phase or a downtrend, supports become what? Resistance. So you just start there and just supports become resistance. Oh, that makes sense. Yeah. Why does that make sense? Because the people that own them at certain places, they're like, oh, thank God I can get out, break even. Like when you start to see this, it makes so much sense. Like here's that level, that break even level for those people that own that on Monday. And then when it finally got back up there, what'd they do? They got out. Again, when it broke and they could get out at that level, what'd they do? They got out and then it held. And then it did the flim-flam. And then you come to this level and you're going, oh, okay. So that if you start to think about it that way, it starts to make so much sense, right? These closes and then how you act at those closes. So keep that in mind. It's really important in a market like this. So this is definitely one you have to watch. Because they're breaking down. We can get into AVGO and some of these other names, but you look at Tesla and go, well, what did we really do? And this is really one to me that's pretty fascinating because, from a tariff perspective, I was reading this report last night. No one has more domestic cars than them on a percentage basis. Nobody. So no one's least affected on a percentage basis from a domestic standpoint than them. Now, overseas, I think they're a lightning rod. But domestically, I think this is pretty interesting. And we'll see how this goes. But you can see our levels right here and how we held those areas. Does it get back there? If you're looking at something like this, I would pay attention to these areas of interest. But if we're here and we're looking at this and we'll clean it all off, what did we really do? We have that gravestone right here. That's a gravestone doji right there. You really don't want to see that at the top of a chart. And we can see how we acted. Did we gap fill? No, we didn't gap fill. I will leave you with this. I do think all this stuff's going to retest those November levels. And that's going to take me to this, which I think is really important for people to get, because a lot of us, like I've been trading MSTR a lot. I've done quite well with it, but you're setting up here to finally roll over. And then people are going to go and look at this and say, well, here's your death cross. And I say it. I mean, I see it coming. I'm not stupid. But again, I make the argument that like, oh, here's your death cross. Ooh, well, what happened 12 months later? Oh, I don't know if I bought it. Are you up or down? So like, you have to put these things in context of what they are. So, by the time this happens, you're just better off. Just again, I'll give you a great example of this. I mean, go back and look at the videos that we did in January on this, saying that this is probably your high because you have this divergence here on the RSI. And every single correction that's ever happened with this led to a divergence. Like every single one had a divergence. Like you can't make this stuff up. Here it is again. And then people are going to talk about their silly death cross. You see this right here? So there's better tools sometimes in the toolbox to determine what you're doing. And that's my point. But when I look at something like this here, we'll take the top, we'll drop the VWAP here, and we'll go, oh, we can't get above that. Now I got this death cross. Yeah, I got it. But if we look at it from this perspective and we dropped in and just said, well, here's your support line. I personally think everything's got to go back to that November 5th, 6th area and retest. And I think that that's where this is going. So even as somebody that currently, it plays around with this a lot, that's that 25 VWAP. I just want to see where they're at. And then you look at the VWAP up here. It's not holding. So what we really want to watch with everything is this is where we closed. That's where you closed before the election. If you start breaking these levels, we really have to start watching how this stuff's going to play out. And that means that the coins of the world and all this stuff that's rolling back over, yeah, this stuff can get way, way worse. And we want to be cognizant of that. So it doesn't mean that we want to just plow into them, right? Whether it's the PLTRs or any of that stuff. But let's get back to this before I go off on one of my tangents. I think it's really important to grasp this and say, yep, if I break these levels, then I have to watch. I think Bitcoin's the next one that's probably going to come in, and we'll see a 7 handle in there. And that probably, to me, is going to contract the NAV spread. Well, I'll do this on Monday if there's enough interest. If there is, drop it in comments. But I think it's going to contract the NAV spread between MicroStrategies and Bitcoin. That's it.